traders. I wanted to talk about margin accounts, specifically as they pertain to trading options. Those of you that have been trading stocks for a while, I'm sure, are familiar with margin accounts. Essentially, all a margin account is your broker is giving you additional leverage. And as it relates to stocks, your broker is allowing you to buy more stock than you have cash in your account. This is also referred to as your buying power. So you'll see where I have stock BP. BP stands for buying power. And most brokers will give you double the buying power for stocks than cash you have in your account. So if you have $5,000 in your account, your broker will allow you to buy $10,000 worth of stock. That additional buying power they're giving you is basically a loan, and they will charge you a small interest rate for any amount of additional buying power you use beyond the actual value of your account. But when it comes to options, that's not the case. A broker does not give you additional buying power for options. The option buying power is the same as the cash in your account. And that's confusing to most new options traders because they think if they open a margin account, that's going to allow them to buy more options than they can afford, and they could possibly lose more money than they have cash in their account. But brokers don't allow that because options are riskier. Options are fixed time investments. They will eventually expire. And so a broker is not going to loan you that additional money when they realize there's a risk that you could buy a really cheap option and it expire worthless. With stocks, they do because stocks have true value to them, and you can hold on to a stock forever so that even if a stock drops, the broker knows they can sell that stock and recoup that money they've loaned to you, whereas options, that's just not the case. So hopefully that clears that up. When it comes to margin and buying options, you cannot buy more options than you have cash in your account. But where margin does come into play is if you're selling options. If you're selling puts, if you're selling calls, your broker does give you some additional leverage to use that margin to basically control more shares of stock than you can actually afford to buy with the cash you have in your account. And that will become more clear when we start going through some examples here in a second. One thing to note before we get into the examples is that when you use margin in the way that I'm going to explain here in a second, there is no interest charged on that margin. So like I said before with stocks, you would be charged an interest rate if you used additional buying power. In the case of where you use margin for selling puts, there is no interest rate charge because in this instance, you're not using that margin to actually buy something. You're using it as collateral. You're just setting aside that money in the event something happens and you have to buy stock. So in that instance, it is not used as margin in the same way it is for stocks, so therefore there is no interest rate. So I have a few examples here. This is going to be examples for selling puts since that's the main strategy I use, but this would apply to selling calls as well. This will give you an idea of how margin is applied to selling puts. So you can see, I have a $5,000 account, and I have also $5,000 worth of buying power. And let's take a look at American Airlines. These are real prices and strikes that I pulled. So this would be a realistic trade that I would take. And so I'm looking at American Airlines. The stock is currently at $44.91. The strike that I'm looking at is 43. It's for the June 8th expiration. It has a 74% chance of success. The option is currently worth 42 cents, so $42 per contract. And let's say that I sell one contract. Okay. When I sell one contract, my broker is only going to require me to put up $707 to sell that one contract, even though the notional value, and the notional value is the actual value of what I would have to pay if I were to buy the stock, is $4,300. So even though I'm controlling $4,300 worth of stock, I only have to put up $707. That's my buying power. That's my margin requirement. And you can see once I do that, it reduces my overall buying power that's available to me for options now. Before I had the one contract, I had my full 5,000 of buying power, but now that I sell that one contract, it's going to reduce it to 4,292, and now I'm using up 14% of my buying power. But the cool thing about this is, versus a cash account, if you had just a cash account and you were selling puts, you would be required to have $4,300 in your account. You would essentially be using up the majority of your account just to sell this one contract. But me, with a margin account, I only have to put up $707. I'm going to receive a $42 credit, and you can see that my return, so ROM stands for return on margin, ROC stands for return on capital. So what I'm doing here is I'm saying, okay, if I'm using my margin of 707 and I can make $42 off of that, that's a 5.9% return that I'm making in about 10 days. Versus in a cash account, I'm only going to make about a 1% return because I'm having to put up $4,300 to make that same 42. So that's where margin gives you a lot greater of advantage and a lot more leverage, is that you can get a higher percent return because you're having to put up less money. Okay, and let's look at it and say, okay, I want to sell a put on Micron Technologies as well for the 57 strike, and it has an 81% chance of success. And let's say I do one contract of it. You can see now that's going to require $792 of my buying power versus having to put up $5,700 if I had a cash account. I'm going to get a $45 credit. My return on margin is a 5.7% return by June 8th versus only a 0.8% return if I had a cash account and was required to put up $5,700. I mean, if you only had a $5,000 account, you would not even be able to trade Micron Technologies in this example. So that's again why I trade a margin account, is it allows me to sell puts on stocks that I wouldn't otherwise be able to afford if I had to solely have the cash in my account to trade it. And then lastly, let's say that I do one contract on Twitter. That's going to take up another $509 of my buying power. That would be the equivalent of $3,200 in a cash account. I get a credit of $30, and then you can see I have a 5.9% return on margin. In total, that's taking up about $2,000 of my buying power, which leaves me still with $2,991 of buying power left to use. That equates to $13,200 worth of stock. So I'm on the hook for this $13,200. If all these stocks went to zero, I would have to pony up $13,200 because that's the value of those stocks at these strike prices. And this scares a lot of people when they think of, oh my goodness, you know, I don't have the $13,200 if I ever have to worry about putting up that money. But really, you're not at risk of having to fork out $13,200 unless the stocks go to zero. And your broker would not give you this type of leverage if they thought that risk truly existed. If they really thought there was a risk of you losing $13,200, they would never give you this low of buying power for you to control that much of stock. I mean, when brokers are looking at, I think I have it up here. When brokers are looking at the risk of a stock, they're looking at the standard deviation. Just like how, you know, most of us traders look at this when we're determining the expected move or we're determining what strike prices we want to trade. Brokers are looking at this same information, and they know that realistically a stock only trades within a certain range. You know, 99.7% of the time, a stock is going to trade within the 3 standard deviation. And I think for brokers, they're usually looking at the 2 standard deviation move when they're determining what their risk level is. So they know that the chance of that stock going to zero is pretty much impossible. They're looking more at what is the chance of a stock moving to certain levels within the time frame of the option. So again, that's why they're willing to give you this type of leverage. Before I jump into some more specifics about this, I want to explain how I'm coming up with the amount of money, the amount of buying power that's required for these options. If we go look at TD Ameritrade's, they have a PDF that explains how they do their margin calculation, their buying power calculation. I'm not going to read through this, but you can pause it and read through it if you want to. They explain the 3 different methods that they calculate the buying power, and they take the higher of the 3, and they even give some examples in this PDF. Also for Tastyworks, they use the same formula, so it's pretty common across brokers. This is how they lay it out. So I'm essentially using this calculation in my spreadsheet. And if we actually go into my Thinkorswim platform and execute one of these trades, you'll see that it matches up pretty closely to what they show me. So I'm at the June 8th expiration, American Airlines. I did the 43 strike for 1 contract. If I hit confirm and send, this is my play account, by the way. You can see it tells you what the buying power effect is. Your buying power is going to be reduced by $711, and it's going to leave you with $4,288 for options. So if we go back, you can see that my calculation shows 707 for American Airlines, so it's pretty close. This is 711 minus 707, and if we didn't have the other trades going on, you can see that my leftover buying power for this is 4,292, which is pretty close to the resulting buying power that it shows here. So if I hit send, right now, if you look in the top left, your option buying power is 5,000. Once I hit send, it now drops to 4,288. Your account value is still 5,000. So when you use up your buying power, it's not like you're actually buying something with that money. It's just that that money is being set aside in the event that you have to buy the stock. So your account value always will include that buying power amount. It's still $5,000. It just now shows that, okay, for any future trades, you only have 4,288 available to trade with. So if you wanted to go, say, buy an option or buy a call, you would only be able to use this amount. You can't use your full 5,000 because 711 of that is being set aside for the buying power for the put you just sold. And we could go through each one of these other examples because I looked at them earlier, and the calculation that I have is pretty close to what they show in the trading platform. It's off by maybe $2 or $3. So this spreadsheet will give us a pretty true representation of what the calculation will look like. So this sounds great, right? Margin gives you more leverage. It's going to give you a higher return every week versus if you had to have a cash account. So what is the downside to trading a margin account? The downside is the temptation to use all of your margin up. So, you see that $2,900 sitting there and you think, man, I'm going to put on more contracts so I can generate more credit. So let's say we do 2 contracts now for each. Now I'm going to get paid $234. I'm getting double the amount for the same time period. It's now taking up 4,000 of my buying power. There's 982 left. Now I'm using up 80% of my buying power, and I'm controlling $26,400 worth of stock. And let's up this one to say 3 contracts to where now I'm using pretty much all my buying power. I'm using up 96% of my buying power, and I'm getting paid $279. So this is great. As long as these stocks stay above our strike prices, we're fine. There's no issues. Where we run into issues with a margin account is if the stocks start to drop below our strike prices. I'm going to copy the original prices so that we don't forget what they are. But let's say that American Airlines drops down to 42. The buying power reduction is not a set amount. When we started off, the buying power required to do 2 contracts was 1,414. But as the stock starts to drop, in the case of a put, your broker is going to require you to have more buying power available to cover that position, because now it's moving closer to your strike price, and even once it goes beyond the strike price, they're going to require you to have more and more buying power available to cover that position. So again, if we put that back to 43, this buying power now jumps to 1,700. Well, since you used the majority of your buying power to begin with, you don't have additional buying power available to cover that additional amount that's required for that position. So now your account goes in the red $115. Your buying power is now negative $115. And this is what's called a margin call. A margin call is when your buying power goes into the red and your broker requires you to deposit money or to close out positions to now make your account be back in the positive. And it's a little scary the first time you get a margin call. You get the sense that, oh man, somebody's going to show up at my house and, break my kneecaps kind of thing if I don't deposit the money. I know the first time I got one, I kind of freaked out. And I messaged Thinkorswim and the support app to ask them, how long do I have to resolve this? And I think they told me it was 7 days when I asked the question. And anytime I get a margin call, I normally will just double check with them just to make sure, how long do I have to resolve it? If I think it's going to take me maybe a few days to clear this up. So there's a few ways you could clear this up. You could, deposit the $115 in your account, and that would cover the margin call. But let's say, it was an amount that you didn't have available to transfer. Let's say, for example, not only did American Airlines drop, but let's say that Micron Technologies dropped as well. Maybe they dropped down to 56. Like, wow, now you got to deposit $1,399 in your account to cover this. So since you have, about 7 days to resolve it, sometimes when I'm in a margin call, I may just wait it out for a few days to see if the stock will recover. My hope is that Micron will come back up, maybe to something more reasonable, back above my strike price. And if I know that, okay, this is expiring in a few days, I may hold out and wait to see if Micron closes above my strike, and then I will get to close this position out and free up this buying power. Because let's say, for example, on Friday, I can buy back these 3 contracts really cheap. When this goes to 0, watch what happens. Now, all of a sudden, my option buying power goes back up to 2,200 because I freed up the buying power those 3 contracts were controlling. So that's one way you can resolve when your buying power goes in the negative. Instead of depositing money, you can wait a few days to see if it recovers, or you can close out some positions that you have that are currently, already profitable. If I was already up on my Twitter trade and it was above my strike price, I may just close those out altogether. And that now brings me back into the green on my option buying power. So again, the risk with margin is when you start off utilizing the full buying power from the onset. And like I said, this works great when the market's going up. Last year it was pretty steady bull market, and I was pressing my margin buying power to where I was using probably 90% of my margin buying power every week, and that's what allowed me to make about 200% last year. I tripled my account. This year has been harder because with stocks dropping, it was constantly causing my buying power to go into the red. So I was either having to deposit some money, or if it was too much to where I didn't have the money available, I'm having to start manipulating some of my existing trades. I may have to close a few of the contracts, because you don't have to close all the contracts at once. If it's a situation where this drops to 42, maybe I'll just close one contract. And by doing so, now I'm back in the green. Now, by closing that one contract, I'm going to take a loss, because since the stock has dropped, when I have to buy back that one contract, I'm going to have to spend more than the 42 cents I I collected, let's say maybe it cost me $1.50 to buy it back. Well, I'm going to lose about $100 by buying that contract back, but I'm forced to do it because I have no other choice. I have to get my buying power back in the green, and since that I maxed out my buying power to begin with, I left myself no cushion in the event when a stock drops. So if you can be disciplined enough to not use all your buying power to begin with, let's say that we just stay with the one contract each trade, you're still getting a good credit, you're still making a nice return, but you're not even using 50% of your buying power. So that, if we go back to what it was originally, we're only using 40% of our buying power from the onset. And let's say that these stocks drastically drop. Let's say that American Airlines drops, 8 points. Let's say it drops down to 36. You're still fine. You're still only using up 54% of your buying power. And let's say that Micron drops, down to 50. You're still okay. And if Twitter drops down to 28, you're still only using up 80% of your buying power. So the takeaway from this is, especially as a new trader, if you're going to trade on margin, if you're going to sell puts on margin, which, I recommend doing because that's really the only way you're going to be able to sell puts unless you have a large account, is to do it on margin. Because otherwise you would have to have $13,000 in cash to be able to trade this on a cash account, versus you could have done this originally with just $2,000 and you could have made the 117 credit. And then again, even though when you get into trouble, you still have enough cushion here to where even when stocks drop significantly, you're not going to have to worry about getting a margin call. So most traders who sell puts or do any kind of sell strategy will tell you you shouldn't use more than 50% of your buying power when you're first starting out trading. So if you wanted to put these 3 trades on with a $5,000 account, maybe you could do, let's say 2 contracts on Micron. That's going to get you right around the 50% level. That way, again, if the stocks did drop on you, you've got yourself enough cushion here to not have to worry about getting a margin call. But in my case, I do tend to press that a little more to where, okay, I may want to use more of my buying power. And I will sometimes get up to the 80 or 90% level. And normally I will do that when I realize that I have other positions. Because again, I'm not doing this all on one stock. You never want to risk all your buying power on just one position. I take my buying power amount and I try to divide it across 5 to 10 positions. That way that if 1 or 2 go against me, I know I have other positions that I can close out if I have to free up that buying power to get myself back in the green if I've got a margin call. So that's definitely something you want to consider when you're putting on these trades, is you want to allocate your buying power across multiple positions. If you're going to push your buying power higher, if you're going to risk putting on, more contracts, just know that as the stocks drop, your buying power requirement is going to go up to where you may be in a situation where you're going to get a margin call, and now you got to put up $499. And, I'm willing to take that risk sometimes because, like I said, maybe I already know my Twitter account, my Twitter stock position is doing really well, that I'm going to close it out soon anyway, to where I know, okay, if I close out one position or one contract, now I'm back in the green. And then if I close it all the way out, my buying power is fine. So again, those are some things to consider. If you're going to start selling puts, again, I recommend starting off not using all the buying power up. Maybe start with 50% and get a feel for, how the buying power works before you start pushing your buying power above that amount. And if you're going to push it, just realize you're going to be at risk that if you do have significant drops in the stock, you could be in a situation where, you're going to have a good bit amount of money you're going to have to either deposit or take some losses by closing out some contracts for a loss just to get yourself back in the green. So I hope that helps. The one other thing I'll just mention too, which I've talked about in other videos, is that once a stock drops below your strike price, in this case if Twitter dropped to 25 and my strike is at 32, you are at risk for early assignment, which in this case would mean you'd be forced to buy $6,400 worth of stock. If that happened, that would also cause your option buying power to reduce by that amount. So this option buying power would be, you'd be in the red, 6,400. That's not as big of a concern because you can easily get out of that situation, which I've explained in other videos, how you can sell the stock and then go right back into the original position you were in on the put. So that's not as big of a concern as the concern of overextending yourself initially on your buying power to where that if the stock drops, you're going to be forced to put up more money or to close out positions for a loss to compensate for how much buying power you're down. If you have any questions, let me know.